Why did Berkshire just sell another 115 million shares of Apple? The answer may surprise you. This recent event has left many scratching their heads. At the center of it all is Warren Buffett, a man known for his unique approach to investments. Buffett sees stocks as businesses and treats the market as a servant, not a master. His philosophy? It's all about long-term value, not short-term charts and trends. Now let's take a look at the portfolio of Berkshire. It owns shares in some of the most iconic companies in the world. We're talking about American Express, Coca-Cola, and of course Apple. These are not just businesses, they are institutions that have stood the test of time. But then, why the sale of Apple shares? The reason for the sale, however, is not as straightforward as you might think. When it comes to investments, Warren Buffett does not play by the rules. Now this might sound like a bold statement, but it's rooted in Buffett's unique investment philosophy. He perceives stocks not as mere financial instruments, but as actual businesses. Instead of letting the market dictate his actions, he uses it as a tool to serve him. This is a fundamental distinction that sets Buffett and his company, Berkshire, apart from many investors. You see, Buffett's approach is not about chasing the latest hot stock or trying to time the market perfectly. It's about understanding the intrinsic value of a business, its potential for growth, and whether it's trading at a price that makes sense. It's about being patient and waiting for the market to present the right opportunities. This philosophy is deeply ingrained in Berkshire's investment strategy and has been instrumental in its success over the years. But it's not a static strategy. Buffett's approach has evolved as the amount of capital at his disposal has changed. With more capital, one can afford to take bigger risks and make larger investments. But Buffett has always been careful to ensure that these investments align with his core philosophy of buying businesses, not just stocks. Take Apple, for instance, a company that Berkshire owned a substantial stake in. To Buffett, Apple wasn't just a tech stock. It was a business with strong fundamentals, a robust ecosystem, and a loyal customer base. It was a business that Berkshire was happy to own unless something extraordinary happened. And something extraordinary did happen. But to understand why Buffett decided to sell Apple shares, we need to first understand his philosophy on taxes. Unlike many investors, Buffett doesn't shy away from paying taxes. He sees it as an obligation to a country that has been generous to him and his company. Now that we understand Buffett's philosophy, let's examine why he felt it was time to sell Apple shares. The sale of Apple shares was not an impulsive decision, but a strategic move. You see, Warren Buffett and his team at Berkshire are not just investors, they are strategists. This sale was a calculated move, influenced by the current conditions of the equity markets and the global economic landscape. In the grand scheme of things, the equity markets are a volatile playground. Prices fluctuate, trends change, and investor sentiments shift. However, Buffett has always been known to navigate these waters with a steady hand and an eye on the horizon. He views the market not as an instructor but as a service, something that offers opportunities rather than dictates actions. This sale is a reflection of that philosophy. Amid the ebb and flow of the equity markets, Buffett saw an opportunity in the form of Apple shares. But why sell now? Well, it all comes down to the global economic landscape. We live in a world where fiscal policies are as changeable as the weather. Governments can, and do, adjust their tax percentages annually, and Buffett, unlike many investors, doesn't shy away from this reality. He sees taxes not as a burden, but as a responsibility, an acknowledgement of the benefits his company has reaped from operating in a country like America. So, what does this mean for Berkshire and its investment strategy moving forward? Buffett's willingness to pay taxes, coupled with his strategic outlook, implies that his approach to investments is not just about making money. It's about understanding the market, assessing the global economic landscape, and making decisions that are beneficial, not just for Berkshire, but also for the wider economy. In the future, we can expect more of these strategic moves from Berkshire. Buffett and his team will continue to monitor the market conditions, assess the global economic landscape, and make investment decisions based on these factors. They will continue to pay their taxes, contribute to the economy, and make strategic investments. In the end, the sale of Apple shares is a testament to Warren Buffett's unique approach to investments, always thinking ahead and making decisions based on the bigger picture.